Good afternoon, and thank you for joining us for today's Value Investor Conference hosted by Gabelli Funds. My name is Jose Garza, and I'm a water, industrials, and infrastructure analyst, as well as co-manager of our 3 utilities funds at Gabelli. Joining us in the second half of that hour will be my colleague Macrae Sykes to discuss Berkshire Hathaway in depth with Chris Bloomstran. For those who are new to us, welcome. This is the virtual version of the annual event we host in conjunction with the Berkshire Annual Meeting in Omaha. This would have been our 14th annual Omaha field trip, and we look forward to hopefully seeing you all in person again next year. In the first half hour, we hope to highlight how significant the underinvestment in the U.S.'s infrastructure has been, and where we stand with utilizing a ramp up on investment as a policy tool for putting the economy back on its feet, not only in the short term, but also for generations to come. To that end, we have 2 experts on infrastructure. Norm Anderson, founder and CEO of CGLA Infrastructure, which is a consultancy based in DC focused on infrastructure, as well as Tim Hassinger, president and CEO of Lindsay Corporation. Tim joined Lindsay in October of 2017 after a long career at Dow AgroSciences. Lindsay has a $950 million market cap and trades under the ticker symbol LNN. Rather than me going into specifics of their companies, I thought I would allow them to discuss what each individual does, individually the company does, and then we'll go into the questions. Please feel free to type in questions into the Q&A box, and we'll get to them towards the end of the 30 minutes, and we'll go through them at the end. Thank you. With that, Norm, would you mind kicking it off?
Sure. Good morning. How are you all? Or good afternoon. Nice to be here. Listen, we focus on infrastructure, and we've been focused for some time on how to figure out how to double the level of infrastructure investment in the U.S. My company's a small company. We're in Washington. I'm right across the street from the Treasury. And we'll talk a little bit later about what the U.S. market looks like, and we'll talk as well about what the prospects are for a stimulus and what that should look like. So anyway, that's how I wanted to get things going with you, Jose. I'll turn it over to Tim now, I think.
Well, thanks. And I have the unique thing to be able to say is I live in Omaha and I can see the CHI Center from my window. So, and nobody showed up for the outing there. But no, Lindsay is a company with roughly $500 million US sales. As Jose said, a market cap that ranges between 950 to $1 billion here over the last, say, 30 days. There's 2 key markets that, 2 key reporting segments, I should say, which is our agriculture, irrigation, and then infrastructure.
Perfect. So before we get into the infrastructure discussion, I thought it would be good to kind of discuss how a CEO of a public company with nearly 1,100 employees is reacting in the current environment. So, Tim, if you wouldn't mind just talking through us about some of your key learnings, kind of navigating the current situation created by COVID-19.
Yeah, sure. So the first thing from my perspective is there were 3 things that we needed to do quickly. And that was keep our employees safe, keep them calm, and make sure they're trusting leadership with the idea that credibility is everything in a time like this. So we set up a daily crisis management team meeting, a group. That group that I lead meets every day, right at middle of the day. We have a weekly communication cadence, a video and a written communication that's going out every week to our employees, addressing key topics, status of the company, changes that are occurring, what are the communication plans, and then every 2 weeks, the top 60 people in the company, we meet every 2 weeks on this kind of forum as it's just an opportunity for them to ask me any question they have or express any concerns they have. The best news I have is we're getting good feedback from our customers. Just yesterday, I received a note from a CEO of someone who's buying our product and indicating that they're really pleased with how it's going. And I really see that as just a reflection of if your employees feel comfortable and they're calm about where they're at in the whole process, I believe they convey that confidence to others. The key learnings or observations is first of all, I want to say is this has been a very difficult crisis management to work through, relative to many others that maybe somebody has had an experience in, and I can say for myself. What made this one really challenging for a manufacturing company was there were all these different work restrictions being put in place around the globe. And even in the case, and just use a few cases in the US, you could have a work restriction conditions by state, by city, and by county, and they wouldn't all be the same. Yeah. And that just caused all kinds of anxiety and uncertainty and things like that. So keeping employees calm during this was really, really important. Another observation that I'm hearing from a lot of my peer group is, and we definitely would reflect this, is the work from home, in essence, our office workers that are now working from home, it's gone better than expected. It's gone actually extremely well from that standpoint. The positive side that I would say has come out of this is, given all the challenges, I can say, and this is just opinion, our company has improved more in the last 6 weeks than any other 6-week time frame since I've been here. It's just been a tremendous opportunity to see where any vulnerabilities or weaknesses that you have, they become more pronounced in this environment, and you're really able to see them and then start putting plans in place to address them. But on an overall basis, I have to say I'm really pleased with how the organization has responded to the challenges, and we're pushing a theme, and the theme in our organization is we need to be playing to win, not a hunker down strategy, which a lot of people are talking about, and that's really resonated with our organization very well.
Yeah, no, that makes a lot of sense, and that's really good context. And yeah, I think a lot of leaders share that notion that work from home has gone particularly well, all things considered. I guess shifting the discussion into the topic of infrastructure. Norm, you guys have put a lot of thought leadership out there as far as where we are. And relative to historical. So if you wouldn't mind just giving us context for things today as far as U.S. infrastructure goes and the spending and the perception of it.
Great. And Tim, I just wanted to echo what you said, the idea that you're playing to win and not hunkering down. I'm reading a lot of George Patton these days, and that's what Patton was all about: move fast and save lives.
Yeah.
That's a really good introduction to what I'm talking about. If you look at where we are right now, and if you look at the state of U.S. infrastructure, we only invest about 1.3% of GDP in our infrastructure, Jose, and we've, historically invested 3 to 4% of GDP. So you've got a deficit, and it's also a sustained deficit. Over the last 40 years, our investment in infrastructure has declined. Plus, the other big problem, is that our infrastructure is now old, average age 55 to 60 years. And then the third issue, which is critical to most of our thinking, is that there's a lot of technology that's going into infrastructure. And it's not just 5G and driverless vehicles. There's a huge amount of digitization that's going into infrastructure, and that's what makes economies productive. And then the other thing that we see as a way to frame this discussion is that, we've been the consumption economy. It's almost as if to be a patriot, you have to consume, right? You have to go buy, I don't know, a couple of shirts a week or something, because if you consume, you're driving the global economy forward. That's not going to happen in the future. Huge amount of debt, right? So we're going to turn into a savings and investment economy. We think that's good for infrastructure. We think that's really important for infrastructure. Another trend that I think is absolutely critical is this nearshoring piece of the business, right? Where we bring our supply chains, my goodness, for health, for almost everything we're talking about in terms of technology, in terms of defense. We've got a project with the people across the street looking at strategic minerals. We bring that supply chain home. That's incredibly complex, and that's going to drive huge demand for infrastructure in the US, in Mexico, and in Canada, and probably in the Americas in general. So from our point of view, there's a huge pent-up demand. There's a huge opportunity. We're very concerned about, and we can get into this in a minute, but we're very concerned about the people on Capitol Hill getting along. We're very concerned about how they get along with the White House and whether we actually get the kind of infrastructure stimulus that we need, that we not just need, but desperately need.
Yeah, and to that end, where are we in terms of the consumer's perception of where we are in infrastructure?
Yeah, that's a fantastic question, and it's a really interesting question. We've been, since the crisis started, one of the things we've been doing to stay in touch with our clients, and we have a database of about 60,000 infrastructure executives around the world. We have an initiative called Blueprint 2025 that's really focused on doubling the level of U.S. infrastructure investment. We did 2 surveys. We've done 4 surveys, 2 global surveys, 2 U.S. surveys. In the last global survey, one of the questions we asked was around the infrastructure brand, because if you think about it, and if you think about some of Tim's challenges and the challenge of the U.S. Economy as well, we need to recover, but the global economy needs to recover. The Europeans are not in great shape, but emerging markets are going to be hit very hard by COVID. And what we found was that in emerging markets, about 84% of respondents, and these are people from the infrastructure industry, say that the infrastructure brand is either mediocre or weak. But what we found, which was extraordinary, is in the US, it's 94% of respondents said the brand is either mediocre or weak. So we're trying to get people organized around making major investments in infrastructure. And it's basically saying, why don't you buy brand X, which you've had a really bad experience with, right? So there's a huge amount of work that needs to be done around building up people's appreciation of the industry. And one of the problems is obviously that people don't know what it is. So maybe it's highways, roads, and bridges. Maybe it's, when we do surveys, it's not highways, roads, and bridges. It's not airports. It's health. So that means water, and it's mobility. So that means the kind of things that Tim does, but safety, but moving people faster so people have better lives. That's how people think about infrastructure.
Yeah, and Tim, any kind of data as far as the customers you primarily deal with, which is on the road safety side and road repairs?
Well, if you look at it a little higher level than that, just say the states here recently have requested Congress to infuse roughly $550 billion in a 4th stimulus package. $50 billion of that is targeted towards transportation. So the House Democrats are expected to introduce an economic stimulus in the coming weeks here that could exceed as much as $1 trillion is what we're picking up. So that's going to obviously address a lot of the state budget concerns and infrastructure needs. The Senate's going to be forced to respond to these states' requests. From our standpoint, obviously, if any of that investment is made, we feel we're in a good position with our portfolio, whether it's road safety products or road zipper, to be able to participate in many of those projects.
Excellent. Norm, in touching on what you said about Blueprint 2025, there are obviously plans that even the president has discussed and that the Congress is laying out there. Where do we stand as far as plans that are out there, and maybe discuss some of yours that you've put forward? Sure.
And going back to Tim just briefly, one of the things that I'm concerned about, Tim, because you've heard forever about big time infrastructure investments. I mean, since 2015, we've heard about $2 trillion, and none of that's happened. But we've heard the same words since the Clinton election in 1993 that we're behind in terms of infrastructure. And one of my concerns, I'll get to our plan in a second, Jose, but one of my concerns is that time goes pretty fast. And we've got a crisis right now, and it's a big crisis. And I think a very significant infrastructure stimulus has to happen, but it has to happen quickly. If it doesn't happen quickly, we move into election season where Nancy Pelosi is not going to give $1 trillion or $2 trillion to Donald Trump. That's not going to happen the closer we get to the election. We need that. We need this in this next stimulus. And there's a lot of debate inside the Congress, even among the Democrats, about what they want in terms of a stimulus. And of course, Mitch McConnell says, you know, no more debt. But what we're looking at, Jose, is to try to bring this down to the level of human beings, voters, people with voices, and companies like Tim's that are people who create jobs, need to maintain jobs. So what we've done is we've looked at every single project that we could identify in the US, working with industry, that will create jobs, that will put shovels in the ground starting June 1st. And we came up with about 480 projects. It's a little over $1 billion in terms of it, a little over $1 billion in terms of, it's a little over $1 trillion in terms of infrastructure investment. You know, these are 4 or 5 year investments, but it's over $1 trillion. And it would create as many as 2.2 million jobs. That sounds fantastic, but if you think about it, we've just lost 30 million jobs. Creating 2.2 would be a way to not just restart our economy, but give people an injection of confidence, right? So we think it's absolutely critical that we do that. But I'm sitting in Washington, I talk to these guys all the time, and it's 50-50 at best that we'll actually have an infrastructure stimulus. That's one of the things that I'm really worried about.
You know, Norman, Jose, if I can just jump in, I share your view. I will tell you the one thing that I think is different though is if you go back over the last couple of years, our position publicly had been, we didn't expect, and we used the phrase, a big bang.
Right.
You know, it was going to be more piecemeal. I think there's an opportunity here, greater odds than it's ever been. And that's a US message. And I think if you go globally, from our standpoint at least, we think, you know, there will be more money invested in infrastructure over the next 18, 24 months than you know, historically there any plans were in place to do so. So I do think there'll be a lift. How big, to be determined.
Right. Okay. And you know, one message, just to go back, Tim, is that my message to you is that it has to come from you guys. It has to come from the governors. They have to make it very clear to the people on Capitol Hill and the president that we have to have an infrastructure stimulus. You don't get to not do it one more time.
Yeah, no, I would agree.
Yeah. Norm, how do you motivate private capital to invest in this? And I think the plan that you guys have laid out is basically 50-50 ultimately. So how do you motivate private outcomes?
Yeah, I think, you know, there's this sort of Larry Summers school that, you know, debt will never harm the economy, right? 30 trillion, 40 trillion, as long as there's cash flow to service the debt, everything's wonderful. We're worried about the amount of money, debt we're going to leave to our children and grandchildren, right? It's a lot of money right now. So we're really focused on the fact that the country has $27 trillion in institutional funds, pension funds, life insurance money. And you've really got to start to focus on how to channel that money into really good infrastructure projects. That's the challenge that we face. And I do think 50-50 is a good way to look at it. That would get us up to 2.3%, maybe even 3% of GDP invested in infrastructure. But you've got to make it, you're going to have to do serious alterations in terms of how Washington works. You know, one of the things, if you think about it, Jose and Tim, we're talking about infrastructure, but there's no infrastructure budget in the US government. There's no Department of Infrastructure. There's nobody in charge of infrastructure in the White House, right? So there's a lot of, that's ridiculous. There's a lot of work that needs to be done before we're going to be able to really channel significant funds into infrastructure in a way that works. Because the other thing that's absolutely critical is that we don't make the same mistakes that we made during the 2009 stimulus, where we ended up doing shovel-ready sidewalks and shovel-ready bike paths, and essentially left the country with more debt than it had. This stimulus needs to leave us with real assets that make our economy productive going into the next 10 or 20 years. Because this period right now is it's critical, right? And I'm not sure, I like Tim because we just met, but I'm not sure I agree with Tim about the global stimulus. My concern, Tim, globally is that these economies are so weak and their healthcare systems are so weak and their level of debt's so significant already that unless the first world, World Bank, et cetera, make a big decision about an infrastructure stimulus for those guys, they're going to be moving along slowly for the next 5 or 6 years. You know, we're already talking about a lost decade for Latin America. That's huge, right? And if you look at the countries in Latin America, Argentina, Brazil, Mexico, Venezuela, you know, the story's already there. And a place like Peru is being ravaged by COVID. So, you know, I think part of my job is to wake people up to non-positive events. And I think one of the things we have is a real challenge on our border.
Yeah, well, there's no doubt there's what you're saying is going to be a dynamic in those countries. But we are seeing places like Western Europe where there has been some investment that would not have occurred as a result of this. But I want to come back on what you just said and see if we're seeing the world the same on this. This whole public-private partnership has been small, but we are seeing an increased motivation and really coming from the states. We're picking up, there's about 10 states that want to move more in this direction. So you're coming from a small base, but our view is there is an increasing desire to go this direction.
So, you know, if I can answer that, is that okay, Jose?
Yeah, of course.
It's probably one of the questions that your folks are going to ask anyway. Look, on the public-private partnership piece of this, we need to figure out how to get increased money quickly into infrastructure projects, right? PPPs don't do that, right? The average, it takes 2 to 3 years in terms of the legal structuring, et cetera. And we need to move fast. So I think one of the things I would argue is that there's a whole range of ways to do that. I actually have a paper where we identified 8 different channels of getting private investment into infrastructure projects. PPPs is only one of them, and it takes longer, right? We did zero. I think we closed 0 PPPs in the U.S. last year. Only 8 were closed in all of Latin America. But there's a huge amount of money that needs to go into projects. And in our recent survey, people actually suggested that concessions were a much more effective way for them to get involved in infrastructure projects than PPPs. So, I mean, but not necessarily disagreeing with you, Tim, because PPPs is a sort of a weird general term of art that means different things to different people. But the sort of standard thing that let's say the Australians and the English have been trying to foist on us isn't exactly working very well. If we got 0 last year. So, and you know, it's based on the apportionment of risk, and risk is of course going to be giant going forward. And we need strategic silver bullets to get pension fund money into the right projects that are going to create value for a long time.
Yeah. And just working back on some of the math that you gave, Norm, as far as the 2.2 million jobs, how do you kind of derive that number in your plan? And, you know, obviously a big selling point to officials out there as far as, you know, jobs.
Yeah, so we've been doing this for a long time. You know, the World Bank will say that every $1 billion invested in infrastructure, an infrastructure project yields 15,000 jobs and 2 to 3 times as many indirect jobs. Direct jobs is 15,000. That's a ridiculous figure, right? That's like the pharaohs in the pyramids didn't employ that many people. So what we've been doing is looking at different kinds of projects, highway projects, bridge projects, transit projects, water projects, and coming up with rules of thumb. We've put those into algorithms, and then we work with the planners and the engineers to make sure that we're right. So all the projects that we identified for you, they actually have a direct and indirect job number attached to them. And we've also put those on a map. I can share with you all the map. It's super password protected because we don't need anybody causing us problems in our sandbox. But what's really interesting about this map is it then has 480 projects that are ready to go. And it gives you exactly, where they are, what they're going to do, the amount of money that needs to be invested in each one, and the jobs, direct and indirect, that each will create. And then what we've also done is overlaying that with where the jobs where the workers come from, and then where manufacturing jobs, like Tim's jobs, would be created, manufacturing clusters around the US. And if you do that with those 480 jobs, you create jobs in every single congressional district. And that's the tool we want to use to make sure that Capitol Hill this time actually responds to the necessity, and pretty brutal necessity, of a strong infrastructure stimulus. I mean, you got to go big, right? This has to be, as Tim said, this has to be a big bang, right? Without a big bang, we're 3 to 4 years into the recovery, just like it took 3 to 4 years to recover after the 1918 pandemic.
Yeah, no, certainly. And I think that's one of the big criticisms on kind of broad-reaching infrastructure bills, period.
Right.
I wanted to turn over and see if there were any Q&A from the audience. Chris, I don't know if there's anything.
Yeah, we don't have any in there at the moment, but as a reminder, you can enter the Q&A with the Q&A button at the bottom of your screen.
Okay, thank you. So, I mean, I guess the big thing that maybe people want to take away is kind of the probabilities of success in the short term here. We talked a little bit about maybe the fourth stimulus, but I guess if each of you wouldn't mind just going through what you think will happen here in 2020 as far as this debate goes and real push forward.
Please go ahead, Tim, if you like, and then I'll follow up.
Well, from a Lindsay standpoint, two key things have changed in our portfolio over the last year, which is due to MASH, we've had a new update, refreshment of our road safety portfolio. And the second is on Road Zipper, we implemented what we refer to as the shift left, which is a way of saying that we're getting more involved at the planning and design stage of a project, as opposed to waiting until the problem is already in place. We are looking at this as an environment where I would say the probability of an increased amount of money being spent on investment is higher today than it was a couple of years ago. I feel real good that we're positioned to be able to participate in that increased investment. So we've got the best road safety portfolio we've ever had as a result of this refresh that's happened through MASH. And then Road Zipper, we've had a couple large projects here just recently, one in the UK that was announced, which is this shift left. I think that fits extremely well in an environment if this increased infrastructure spend occurs. So that's our position and how we want to go forward with this.
That's great. Jose, I saw you have a couple of questions. Do you want to go to those, or would you like us to wrap it up?
We can, I guess, comment on this. There's one here that says, comment on the educational infrastructure and where that fits in. Obviously, that's been a big change.
Well, that's a gigantic question, right? I mean, one of the things that we think is that social infrastructure is where private money ought to be able to go pretty quickly. And there's a huge opportunity both in terms of hospitals and in terms of educational facilities to get private investment into those assets. So, my answer is, when I talk about infrastructure, I'm talking about transport, energy, I'm talking about water. We're talking about anything having to do with 5G, including smart cities. And by the way, cities, not just creating data, but actually monetizing data as a way to generate revenue to invest in additional infrastructure. So I think that's really important. And the social infrastructure piece is absolutely key here. And I think what we're going to do is see a huge amount of investment, not just in hospital and healthcare infrastructure going forward, all the pent-up investment that we probably didn't make over the last 10 years, but we'll see the same kind of thing in education. But I also tend to think that the educational system has just got a giant wake-up call, And it, you know, we're looking at a very different kind of education system going forward, probably with a lot more technology, a lot more one-on-one teaching, less big classes, et cetera. So I think there's a big change there.
Tim, I don't know if you have anything to add.
No, I would bring it down to our company, the whole work from home and then how you interact with your customers has obviously changed a lot. How we're able to now take that into our training programs and cascade that information. There's some real learnings that have come out of here. And to me, one of the biggest things for Lindsay, and I think this is probably characteristic of a lot of companies, a lot more confidence in the use of technology to be able to do that effectively, as opposed to the traditional bring everybody in to one site and try to do the education or training at that point. So this is going to change a lot of our interactions with our customers, especially in the area of training and on the educational side.
Yeah, that's great.
Perfect.
So, so if you want, I can quickly do my summary. Is that okay, or would you?
Sure.
No,
just real quick.
I wanted to add the part. This is something we haven't seen anything like this in 100 years, and so I do think that the next month or so are critical in terms of public decision making. We need to get this right. We're still focused on testing. We're still focused on contact tracing, et cetera. We need teams of people to do that, but we really do need the people in Congress and people in the White House to shift focus to a very quick, very abrupt economic recovery. It has to be robust. It has to be quick. That's what I'm worried about, because I think that people like Tim who are creating jobs and maintaining jobs, they deserve fantastic leadership from their public officials, and we just have to, all of us have to get together to make that happen.
Excellent. Well, thank you guys very much. We've hit our half hour, so appreciate it, and thanks so much. I guess now we'll turn it over to my colleague Macrae Sykes. Mac has been with Gabelli for over 10 years and responsible for our coverage of financial institutions. He and Chris Bloomstran will go over Berkshire Hathaway. Thanks so much.
Thanks, Jose.
Great. Thank you, Jose. That was terrific. So I'm actually very excited in lieu of actually being in Omaha today to be joined by Chris Bloomstran, who I've seen there for many years. We've been communicating about Berkshire Hathaway, one of our favorite subjects, obviously. I'm delighted to have him here for everyone. In addition to being a great investor, Chris is a very insightful analyst as it comes to Berkshire Hathaway, and I think pretty unique in his approach and introspective and detail of the conglomerate. So to give you a little background, Chris is president and chief investment officer at Semper Augustus Investment Group. Chris has over 29 years of professional experience with a value-driven approach to fundamental equity and industry research. Semper Augustus manages concentrated, all-cap portfolios with typically long holding periods and a general benchmark. Chris received his Bachelor of Science in Finance from the University of Colorado at Boulder. He also played football there. He serves as the president of the board of directors for the CF Society in St. Louis and has been a director on the board since 2001. Chris writes extensively about Berkshire Hathaway and more broadly on thematical topics related to the stock market and the economy. His annual year-end letter is widely read among the value investing community. He very much enjoys giving back mentorship and loves speaking regularly at many colleges and universities. Most recently, he was honored to speak at Columbia Business School's Hybrid Center for Graham and Dodd Investing. I am really delighted to have Chris here today to talk about Berkshire Hathaway, and please welcome Chris.
Hey, Matt, good to see you. It's great that you guys put this thing together. It's very unusual not being in Omaha on the first Saturday in May.
Why don't you show us your badge just to feel a little familiar with the event.
This was going to be my 20th meeting. We bought the stock for the first time in February 2000, so I found my April 29, 2000 badge. I missed 2001 when my first child, my daughter, was born. She's now 19 years old. Haven't missed a meeting since. Anyhow, it's already looking forward to May 1 of 2021.
I hope to see you there. All right, so Chris, let's get started. Before we talk about your high-level thoughts on the conglomerate, maybe we could just react to the Q this morning, get your sense of what came out of that, and then secondarily, if you could just jump to what you expect Warren to talk about at the Q&A today at 4:45 in terms of the outlook for the conglomerate and potential capital allocation signals that you would look for.
I think I and you and anybody that follows Berkshire even from afar, given the magnitude of the crisis underway and the degree to which we think the stock is undervalued, we very much expected to see a lot more share repurchases. $1.7 billion was underwhelming, but I had thought, given the increased volumes during the quarter, certainly in March, that the company could have bought upwards of 1 year's worth of free cash, so north of $20 billion. They did very little net buying in the stock market, $1.8 billion. If you got into the further footnotes, the statement of financial position, you may have seen that getting into April after quarter end, they sold $6.1 billion. So I presume that reflects that the airline positions are probably gone. Maybe some other holdings. They may have trimmed GM, who knows, but I think the airlines are gone. My sense is, if you looked and you saw it in the back of the, you saw it in the footnotes, all of the share repurchases took place prior to really the crisis getting underway. So they stopped buying on March 10 and bought shares back at higher prices, considerably higher prices than which they had bought back the $5 billion last year. So to see only $1.7 billion, given the enormity of the cash position on the balance sheet, was surprising. And I'm certain he'll address that. I think, with Bill Gates leaving the board and resigning from the Microsoft board, that tells me that, I think the driver of this conservatism in the downturn is probably, I think they're concerned this thing could be far worse than they would have thought in March. And I think sitting on those resources probably makes some sense there. But I think we find the shares, as I know you do too, considerably undervalued. And given how long these cash reserves have been building, to not see them put to work is, frankly, a little disappointing.
Yeah, I do. If you look at the Q, it looks like the share counts decreased almost 5 million shares of the Bs, 3,000 shares of the A. So I think there was a continuation post-March into April on share buybacks. But as you say, on a run rate that would be a little less than exciting. Okay, so now let's talk about why we're here today and really kind of highlight your background and your skill set around the valuation of the conglomerate. In the past, Warren's used book value as a typical benchmark metric for valuing the firm, but a couple of years ago, he referred to the four groves and thinking about a sum of the parts valuation. And I think you've been a big advocate of going over the sum of the parts as being kind of the most reasonable and smart way to value the conglomerate. So maybe you could just talk about why that approach you think is best, why is consistent with Warren as well.
Well, let me start that by suggesting that I think book value, despite this de-emphasis in the last couple of years, is still immensely important at Berkshire Hathaway. You think about the sum of the parts and where the equity capital of the business is. I mean, the insurance operation is still 45, north of 45% of the operation. Statutory capital, at year end was over 200 billion. It's probably, 190-ish billion today, given the recovery in stocks since the end of March. Book value is incredibly important in a property casualty insurance and reinsurance operation. You've got between the railroad and the energy businesses, that's another 80 or so billion dollars in equity. So there you've got, 3/4 of the book value of the business are in businesses where book value is important. You think about the energy business, you earn a regulated return on equity. They earn, roughly 10 as we do the math and make some of the accounting adjustments. And so, and then the balance of the value of the business are the manufacturing, service, and retail businesses, which we struggle with. We think capital allocation has been an issue there. They've bought some things at control premium prices that really has disallowed decent economic returns. But there you've got, book value of the balance. I mean, it's, business does about $150 billion in revenues. They earn, maybe 7.5 on equity is all, which is starting to stretch the limits of where we find the business attractive. But, it's a business that has 2/3 of the book value, the MSR group now, in goodwill and other intangibles. And so, Mr. Buffett would have you believe and tell you over the years that returns on net tangible capital are what drives the bus. And I'd say that's true, except that in this business, most of the profits of that group seem to be upstream to the parent. And I would contend that if you have the ability to reinvest in a business that had a 20+ return on equity, then I can dismiss the goodwill and intangibles. But if you don't have reinvestment opportunity, don't tell me that business, the goodwill that you paid shouldn't be taken into consideration when assessing the profitability. But I think, more to your point, the general approach of a sum of the parts really does make sense. You go back to the early 2000s, maybe 2003, Mr. Buffett laid out in his chairman's letter, the regulated utility business, which then included the railroad. I think that group can stand alone. We still have the luxury as analysts of having separate SEC filings posted by both Berkshire Hathaway Energy and by the railroad. And so you get a lot of granular data there. But then you get to, for years and years, we had the separate leasing businesses, the finance and financial products. Well, those have now been rolled up into this giant manufacturing service retailer group, which, as I said, does about $150 billion in revenues, earns, say an 8% profit margin. It's a big driver of value. We think that MSR group is probably worth, on the order of $170, $180 billion, a slight premium to one-time sales. Go back to the railroad. The rail, we think is conservatively valued at $100 billion. They paid mid $30 billion for it. I think $37 billion. An incredible buy in 2009. We thought it was a mistake at the outcome, at the outset, and have very quickly changed our minds when we realized that the economics of that business had improved versus where they'd been historically. And then the energy business, a very predictable regulated return, business that will do about 10 on equity, is worth somewhere north of $50 billion, $55 billion. So you look at those groves, as Mr. Buffett calls it, of the sum of the parts, and that works. We have another method which reconciles really the earning power of the business against some big moving parts and accounting adjustments to the published GAAP financials that we make. And we think, over the years, we've kind of learned that there's been some hidden value inside the published numbers. I think the lay investor that pulls out the Q today or reads the annual report, if you simply start with the consolidated financial statements to try to get a sense of the profitability of the business, you wouldn't have a clue. There are just too many nuances to the way the accounting works in the business that distort the underlying profitability. So all of these methods that we use are really in an attempt to reconcile against each other, to try to determine, what we think is the core raw earning power on a normalized basis. So with an effort to smooth out a lot of the volatility that comes with stock prices bouncing around from quarter to quarter, or underwriting profitability bouncing around. So I'm trying to get, so if you said to me, Chris, at year end, what do you think Berkshire's worth? I'd give you a number. I think the business is worth, somewhere north of, $730, $740 billion. Well, today, we may be shaving our assessment of the value based on what we think could be a much longer duration of this economic downturn. But in a normal world outside of this crisis, I wouldn't give you much of a different number. We think the business earns 10 on equity durably. We think it's earned that for the last 20 years. And so I've got a method that essentially says, Berkshire's core earning power today is somewhere, around $40 billion. And on that, book value that's today marked to market, given Friday's close in the stocks, probably $390 billion. It's a business that earns about 10 on equity. And so to me, you've got to smooth and you've got to normalize to get to a proper assessment of value.
That's great. Thank you. So you touched briefly on the energy and the rails, but maybe we could delve into the insurance business, which is certainly the crown jewel, as you mentioned. Can you talk about how rare it is for an insurance company to have a history of underwriting profit And what does that mean in terms of valuing the float and whether it's misclassified as a liability under GAAP accounting?
Well, it's a huge advantage. If you look at the history of, the broad industry of property casualty insurance and the reinsurance businesses globally, very few durably underwrite profitably. I think, the history of property casualty sees the industry right at a 1% underwriting loss. Well, Berkshire has a very long history back to 1967 of, as everybody knows, walking away from business when it's mispriced. I think, writing intelligently, you don't see massive adverse reserve development across those businesses. And so with that, you've got this long history of a business that's produced, slightly positive underwriting results. In today's environment with zero interest rates, which appears, to perhaps be the case for the foreseeable future, you better underwrite profitably because you don't have any room for error. Back in the 1970s and early 80s, when interest rates were sky high, you could underwrite at a 5% loss and make up the difference with higher yields on fixed income securities. But if you look at the progression of the capital inside the aggregate of Berkshire Hathaway's insurance businesses, you've got almost $200 billion in equity capital. It was $230 billion at year end. If you think about how the different lines of insurance are written and determine how much capital is required to simply write in those lines, start with GEICO that does half of Berkshire's insurance premiums, a little more than half, so a little over $30 billion. Well, in auto insurance, which is written on an admitted basis, you write, with the insurance commissioner's blessings in each of the states that you're doing business in, you're allowed to write, from a statutory standpoint, $3 of premium for every dollar of capital. We've always assumed that Berkshire writes closer to 2 to 1, but you think about the capital required then. So if you're going to write 30 plus billion, you've got to have $15 billion in capital. I think the business is probably overcapitalized there to an extent, but that's auto, and that's half the insurance book. So if you take, the rest of the statutory capital or even the GAAP capital of the insurance businesses, that's still almost $200 billion. On the balance of the $30 billion written, find another insurance company or reinsurance company that writes $30 billion in premiums on $200 billion in capital. Nobody, it tells you that there's massive overcapitalization in the business that's not required to fund the $37 or $38 billion in kind of normalized annual losses that go out the door. And so for that, the long history of Berkshire is one of being able to invest much more of its invested assets, the float of the business, in common stocks, longer duration assets. Most insurance companies have to invest in bonds and short securities because you'll have periods where losses develop badly, where you've misstated or misunderstood or misestimated what your losses will wind up being. And for that, the admitted side of the business requires a larger fixed income and cash book. If you're writing in reinsurance, if you're writing in specialty business that's not as regulated or not regulated except for the fact that you need credit ratings, not so much of an issue. And so, Berkshire's just this massive overcapitalized thing that allows that stock portfolio. So when you talk about float, I think the question I've gotten more and more over the years is, well, Chris, you're essentially saying the value of the insurance operation is essentially the value of the invested assets. Why aren't you backing off a liability for the float that sits on mostly sits on the right side of the balance sheet? And for that, you've heard Mr. Buffett, Mr. Munger talk, and I think they're right. If you were to break up the business and run off the insurance operations, then that net liability that sits there to pay the losses that develop in insurance is absolutely a liability, and you would pay it out the door. But if GEICO has the ability to grow, and the specialty business has the ability to grow, and if National Indemnity, Gen Re have the ability to grow their premium volume over time, then to the extent Berkshire never has to dip into its pocket out of that surplus capital, it can maintain much higher invested position. And I look at the dividends that are earned from the common stock portfolio, the retained earnings of the investees, the income and interest that's earned on the small portion of bonds, and then the cash that the business has, is really the earning power of the business. Plus, we normalize underwriting profitability to about a pre-tax 5%. So, in our accounting adjustments, we'll take whatever underwriting profits are for the quarter or for the year, and we'll just remove them and assume a 5% pre-tax underwriting margin, which seems to be the right number over time. If you wanted to be more conservative and assume that the entirety of Berkshire's insurance operation would write at break even, then take that 5% margin on $37 billion in premium out and don't count it, and just count effectively the investments on the investment portfolio. But I've never seen Berkshire have to liquidate the common stock portfolio to meet losses. You can go back to 2008 when the common stock portfolio fell from $80 billion to in the high 30s. I mean, the stocks dropped dollar for dollar with the S&P 500, which was down 65%, and Berkshire remained in a net massive overcapitalized position. So it's just a different animal in the insurance world. And it really boils down to that surplus capital that lets us believe that what is, from an accounting standpoint, a true liability, it really is to us, equity capital.
So just to move the discussion a little bit more forward in terms of equity capital, because I think it's important today. I think part of the discussion is what is the ultimate outcome going to be on the insurance businesses from COVID-19 and the health crisis. And, part of the effects have been some positives at GEICO, which we've seen, the rebates, $2.5 billion to go back to the clients. But then there's some concern on the workers' comp side, event cancellation insurance, and potentially other aspects that may filter out. Maybe you could talk a little bit about, in terms of what you've done on the research side, that truly understand what the potential total implications could be to Berkshire going forward. And we did get a glimpse of that in some of the reporting this morning on the Q, in terms of kind of giving us an outlook that there's going to be higher litigation as well. So maybe you could just give us your thoughts on kind of the negative potential aspects to the insurance business. And then also, what does this mean in terms of underwriting going forward for businesses and sovereigns that may look to include pandemic insurance going forward?
Yeah, we've done naturally. I mean, Berkshire is a very big position for us in terms of concentration of capital. And so that's the first thing we did when this crisis evolved, was really dug in and talked to everybody we could, brokers and CEOs of various publicly traded companies. We've leaned on all of our resources in the industry to get comfortable with the obvious risks, and you hit on business interruption and event cancellation. I think in any economic downturn, you mentioned workers' comp, well, that'll be an issue. To the extent we have sustained periods of unemployment, you'll have claims there. D&O insurance tends to see a lot more claims. You've seen Travelers and Chubb and some of the ones that have already reported talk about, having to reserve a little more there and not quite knowing what the tail was going to be. The biggie, the 800-pound gorilla in the room, and you're starting to see it in the newspapers, and we jumped on it very early, was business interruption, which, we've always known to be a property claim. You've seen some lawsuits filed by manufacturers and some restaurants to suggest that a virus can introduce a property claim. Well, if you're a restaurant and you've got an employee or two that wind up with the virus and you've got to close, the counter to that is, well, A, this is not a property claim, and B, if it is a property claim, then our liability extends to the duration of time that the business would be closed that would allow you to clean it. It's not a pandemic cover. The industry learned its lesson after SARS. And so between business interruption and between event cancellation, you typically have exclusions in policies. And it's pretty clear in most of these policies they're excluded. Now, in event cancellation, post-SARS, you actually have to buy a separate rider to cover a pandemic. And it's very expensive, as you're seeing. I mean, the toll on society is just gargantuan today. Very few have bought that rider. I mean, it's on the order of 10%. We did a lot of work on each of the big sports leagues, the NFL, NHL, Major League Baseball, NC2A, we lost March Madness, Formula One abroad. There are a couple of biggies that have for years, the risk committees on the boards at Wimbledon and the British Open, the R&A. They bought the coverage and they've paid the premium. And so you will have some losses there, but we got really comfortable early on in the crisis that we don't think this is going to be a catastrophic cost to the industry. Now, on the flip side of that, you've got politicians railing and saying, well, the property casualty insurance and reinsurance industries ought to bear their fair share, and we ought to effectively rewrite these policies that have been in place. Well, that's crazy. I mean, you know, we've got rule of law. So I think it's entirely possible that some wackadoo judge who, with no doubt is a trial lawyer in a previous life, will entertain a case, will fine for a plaintiff, will award $1 gazillion in damages, and you'll have appeal after appeal after appeal. And ultimately, there's a decent chance that we test the Constitution and the rule of law, and this thing winds up on the court step of the Supreme Court. Unfortunately, I think you've got a Supreme Court in place today that, on balance, respects the rule of law. So you'll have some panic moments, I think, as the crisis evolves, and you'll have some lawsuits. But at the end of the day, unless we're genuinely going to rewrite the rule of law and rewrite a contract, I don't think it's a risk. So going forward, if you think about premium volumes, surely a heck of a lot more people are going to buy event cancellation insurance to cover, you know, any kind of stoppage like this. They'll come with a high enough premium to cover the losses. But really, if you think about the cost to society broadly, the degree to which GDP has declined and the degree to which unemployment here and abroad have risen, there's really not enough capital in the property casualty insurance market. It's, you know, broadly the industry has on the order of $800 billion in capital. It's not enough. I mean, the Fed ginned up, you know, or the Treasury ginned up, you know, $2+ trillion, levered it up through the Federal Reserve. The insurance industry does not have the capital. So you probably wind up with some kind of a public-private partnership, not unlike what you have in the Southeast in Florida with hurricane covers. You have the California Earthquake Authority. So you'll have some taxpayer and some state involvement, I think, ultimately, when we kind of start writing policy coverages going forward. I'd be curious if you guys have the same take, but you know, we don't think there's an immediate risk, but it's a game changer in terms of how we cover these risks prospectively.
That's great. I mean, at the very least, I think the insurance companies will be tied up in court for a while, and that will be costly. So unfortunately, one derivative to the aspects that are occurring today. Chris, we would just want to finish up here, and maybe I'll just give you one more minute to comment. In a world without Warren, you know, how do you see that affecting your intrinsic value today and the outlook for returns going forward?
Well, I would say, you know, if you get into the nuances of our letter, we've been frustrated with some of the capital allocation of late. We've been frustrated with some of what has been stupendous disclosure, you know, the supplementals in the chairman's letter for manufacturing, service, retail, where you got some of the granular data that allowed us as analysts to determine the return on equity capital. Well, now we can't determine the equity capital of the business. But you know, the counter argument to that is, look, this is a huge conglomerate. You started by saying we're going to talk about a conglomerate. There are a lot of moving parts. Mr. Buffett has properly said, you know, don't get stuck in the weeds. You know, try to keep this thing at a high level and do what we do, which is try to drill down to the durable economic earning power of this business. An investor coming in today should have no expectation of earning returns that the business has seen for the last 56 or 57 years. I mean, gone are the 20+%. To us, though, this is a durable 10 on equity. I think there are, and you heard Charlie's comments earlier this week or a couple of weeks ago in the Wall Street Journal. You know, we're going to come out of this crisis and probably close some businesses. There are no doubt some businesses inside the MSR group that don't earn sufficient returns on an unleveraged basis, that businesses that would probably be better off in the hands of private equity, which has been anathema, you know, generally in the history of Berkshire. But there are some opportunities for the next set of managers of the business, I think, to move some of these assets on and off the balance sheet. You know, you go back to, you know, a TransDigm type model with Henry Singleton. I don't think we need to be that active with Berkshire Hathaway. There are still genuinely some phenomenal assets and businesses in the fold, and a lot of the business is predictable. You know, I paint as a worst case scenario the return on unlevered equity capital declining from 10 to 8 over the next decade. Well, if it becomes an 8, you know, that gets down to where it's not that interesting to us as investors. But again, it's an unlevered 8 with no bad accounting, no history of write-offs and write-downs, not a lot of BS. And at 8, you know, it's worth maybe 120% a book. So not far from where it's trading today, worth a little bit more. But if it earns 10 sustainably, then the stock price is worth a lot more than the current bid. The stock's trading at 65 cents on the dollar of fair value if our base assessment is right, and this is an unlevered 10 ROE.
Great, Chris. That was fantastic. Thank you for being here today. On behalf of all of our listeners and the Gabelli Funds, again, thank you for your participation.
We'll see you in New York soon, Mac.
Likewise. Thank you.
Take care.